What's up, guys? Welcome to lesson 12. Last time we saw that the 200 moving average was related very well. It worked with Apple's stocks. And this time we are going to test other moving averages. Why? Is because sometimes we can see that it doesn't work. So, for example, when we see something like, uh, okay, we see that here we are looking at HSBC and we are on the 30-minute chart. But actually here is responds very well. Okay, guys. Actually here it worked, okay? So if we use this as a resistance, it's working pretty well, okay? So it worked, well, more or less here. Here it worked perfectly. Here, more or less. Here just broke a little bit, and here just a little bit. So yeah, more or less it serves as a resistance line, okay? Here it broke it. So we are also plotting. So here, guys, you have, let me put it back. So let's get rid of this. Okay. And we are going to put this one. Yes. Okay. And we have it here. Okay. Let me explain to you guys the difference between this and what we saw last time. So, and they're more or less the same. Okay, this is the 200 MA. If I put the PVA indicator, which is something that I coded myself, the original idea is not mine, is another guy's idea. It's the idea of a trading group. I just translated to PineScript, which is the language used by TradingView. So here, guys, you can see that it respects more if you put the 200 EMA, okay, and the 200 EMA is the exponential moving average. So it's closer to the tops of the candles, okay, of the price. So in this case, in particular, this case, it works better if you use the 200 EMA instead of the 200 MA, okay? So let's get rid of this for a while. Oh, here you can see that it breaks a little bit here, it breaks a little bit here, here not much, right? And this is the 200 MA. Now when you put the 200 EMA, it actually becomes a little bit better, right? For this example.
Yeah.
Okay, so guys, what to do when it doesn't really follow the 200 MA? What you can use is this. So let me show it to you. Is the 200 MA, okay? Why the other one is 220 MA, and why is this 20 MA? Because 20 days is equal to 1 month, because in trading we don't use Saturday and Sunday, so 20 days of trading would be 1 month. Here we are plotting the 30-minute chart, this 30-minute chart, and this 220 MA comes actually from the day when the market used to move once a day. So when each candle, well, a lot of years ago, each candle would be 1 day. So 20 candles would be 1 month, okay? And that's why we use the 20 moving average. If we use the 20 moving average, you can see here, for example, this move is respecting very well the resistance of the 20 MA, which is not here, it doesn't really, well, you could use it maybe here and here, okay? So for you to see this kind of trend would be better to use. Yeah, now I'm ask you a question. If you want to see this trend, which one do you think is better to use? This line, the pink line, which is the 20 moving average, or do you think it's better to use the 5 moving average? Oh, look again. Yeah. See? So which one you think is better to use for you to use to identify this trend?
I think this one, this pink one.
Why?
Because it has a bigger picture than the violet one. Because the the violet one just simply follows it, like attached to it.
Okay, let me. So okay, maybe that's your reason. My reason would be okay. I would explain like this. Okay, you are correct. Okay, you are correct. So this one, right?
Yeah.
Yeah. So you're correct. But why is this one and not this one? Is because if you follow this one, okay, what happens here? Here it breaks. So you probably would have closed it. Understand?
Yep.
Because if you don't have this pink, don't have this pink, right?
Yeah.
You can, let's say you can't see this, okay? So, okay?
Yeah.
And then let's
We'll
do,
be able to visualize in a bigger picture.
yeah, let's do this. See? Now you can see what's happening after that, right? And then when you saw this huge one and you can only see this, and then what do you think? You think, broke it, right? So then you close your trend here. But if you close your trend here, see? If you close your trade here, actually you can, you wouldn't be able to catch this one. Okay? So that's why if you plot back that one, okay? So you plot back this one, okay? And then you see that instead of closing it here, you probably would use both lines, right? And then you probably would have closed it maybe sometime here or even sometime here, right? Because I would probably close it here. So I would probably close it, so I would get it, okay? First time it broke, don't do, okay? Then second time, bounce it back. I'll probably enter sometime here, right? Because it bounced back. Probably enter here. And then I'll probably have closed it like sometime, let me see. I'll probably have closed sometime either here or when it went down.
Yeah.
Probably here. Or probably even here, because I wouldn't know, right? So you already closed a lot. So it depends on which exit rule you're following. So here I don't know, I don't have a specific exit rule. So because even for the exit rule, I would build my exit rule based on the pattern as well. So I would have to see a lot of past examples and before in order to build the exit strategy for this particular trade. So I don't know which one, but probably I would either enter somewhere here or maybe bounce back down here.
Yeah.
Okay, depends. So yeah, so identify this pattern that the 220 works better than this one. Okay, and then so once you know that looks better, so that's when you start giving more priority to that one instead of the 5. Okay. So that was the lesson for today, and I see you guys on our next lesson. In our next lesson. Bye bye.
Bye.